Also, everyone, for more on the jobs report, let's bring in JPMorgan Asset Management Global Market Strategist Meera Pandit and S&P Global Ratings Chief U.S. Economist Beth Ann Bovino. Great to have you both here live in living color on set with us for some reactions to today's jobs report. Meera, I want to begin with you. You see a reading like this and the markets are going to react the way that they do, but it really seems like some of those revisions kind of caught us off guard just a little bit here this morning.
I think the most important takeaway from this is the downward revisions to wages and the fact that wages are starting to slow. That is the most important thing for the Federal Reserve when we think about how they're looking at inflation. They're looking at goods, which have actually started to decline. They're looking at shelter, which we know is going to be hot for a little bit longer and we have to be patient with. But the big question mark is that services X shelter. And in trying to interpret that data, they are very much closely paying attention to wages. So on the one hand, seeing wages start to slow a little bit more is good news for the Fed. On the other hand, you mentioned some notable gains in the usual suspects, leisure and hospitality, other areas of the service industry that paints a little bit of a conflicting picture there that the Fed is going to want to continue to monitor.
Of course, Beth Ann, at the same time, we get the wages that are slower growth, which is good news from a Fed perspective, bad news maybe for individuals who are not making as much money or not seeing their wages rise to pace with inflation. What is all of this? I mean, is it too early to sort of extrapolate what this means for consumer spending?
Yeah, I mean, my takeaway is, look, it is positive to see, particularly for people who are waiting for the Fed to slow down on rate hikes, for wage gains to start to moderate. But as you pointed out, two things I want to take away, I would want to point out. First of all, the BLS numbers, it is an aggregate number. It depends on what industries are impacted in there. So if you're imagining that a lot are going to be leisure and hospitality, which are largely more low-paying jobs, that could bring it down. That's one thing to take into account. But to your point, we have seen that inflation has outpaced wage gains for now. I think this is probably the 21st month. So those people are feeling the pain. Purchasing power has been squeezed. What does this mean for those people when they go to the shopping center and want to pay? We're starting to see people trade down in terms of spending or search for value. That's a squeeze on businesses who are trying to keep their revenues to outpace costs. So that could be a squeeze for not just households, for businesses as well.
Meera, a report like this, maybe down revisions to wages and the prior month jobs, good thing. Does that make you more optimistic on stocks, on the notion that maybe we get that Fed pivot earlier and we're not talking about the Fed raising rates in the back half of the year?
Not so fast. It's just one report. I'd say overall, there is a lot in that report that is in line with some of the consensus expectations, and it's still a very hot labor market. If we looked at the JOLTS report earlier this week, we continue to see very high number of openings reflected in this report. Similarly, some of those same industries in terms of service. And if we look at the Challenger survey from earlier this week, too, those layoffs continue to be very concentrated in a small number of sectors, primarily technology, finance, fintech, some of the areas where cyclically there might have been a little bit of overhiring last year. And they also continue to be very geographically concentrated as well in areas like New York and California. So I do think that we have to continue to monitor the strength of the labor market because we're seeing that downward progress in different areas of inflation. So I think the Fed's focus has really shifted to the labor market, and I'm not sure that this was a weak enough report. It was actually pretty strong in order to give the Fed that ammo to want to start to ease off of those rate hikes yet.
May I just jump in here? I agree with Meera very, very much. When you look at that jobs opening report that came out, it has moderated, but it's still, 10.5 million, which is incredibly strong. If you take that relative to unemployed workers, that means it's about 1.7 times those people who are unemployed. You'd like to see that closer to 1. The Fed would like to see that closer to 1, so they have a long way to go. You talked about the labor participation rate, which did come up, and that's good news. I think it's probably still very close to a 45-year low, which is, again, a real challenge. We need workers to come back, particularly women, prime age workers. We're not seeing that fast enough.
So what does that tell you about the vigilance of the Fed? I know you had used that word in your notes before. So what does this report then kind of signal about that vigilance of them going forward in this year, too?
They're still on watch. I do see with watching the wages start to soften, that is a positive, but I don't think the job's done yet. We're looking at the Fed. We do expect the Fed to continue to raise rates. We're looking at the Fed to get it up by to a little over 5% by, I guess, the end of this year. by mid this year. We don't think, the question is, could they go much higher than that? I think with numbers like this, particularly with the wage gains coming down, that's a real positive. As I said, let's see what the distribution is, and is it really just driven by low-paying jobs? But if that's not the case, if you see it much more broad-based, that does give the Fed time, a reason to start to slow the pace, and that's a positive. But again, even the Fed said during the minutes that their job is not done.
Meera, I'm looking at futures here, which are up on the back of this. What I'm hearing from you guys doesn't support that necessarily. In other words, this report doesn't seem to meaningfully change the trajectory of interest rates from what I'm hearing you two say. So what do you think is going on here? And do you think that the buying stocks on the back of something like this is a good idea?
I think any little crumbs of weakness in the report will be received in the immediate aftermath positively by the markets. Let's see how the next couple of hours, the next few days play out as we think about the overall strength of this report in the context of a strong labor market. But I also think that maybe one of the themes that we're going to see in terms of stock market performance this year is that everyone's expecting this recession. Everyone's expecting a more protracted downturn. We know that markets tend to bottom before the economy, before the labor market, before earnings. So I actually think in contrast to last year, dip buying is going to be a lot more popular as an immediate reaction to some of this different data throughout this year, because people will say, well, maybe the bottom was already in October, so I don't want to miss out, whether it's stocks or bonds. So I think that behavioral reaction function might be a little bit different in 2023 than in 2022. I think people are looking for an excuse to buy a little bit.
Beth Ann, bigger question here, or bigger picture question here, is the power back in the employers? I felt like last year we talked a lot about quiet quitting, but this report supports maybe that shift is now, going back the other way.
I don't see that at this point in time. Look at the numbers. I mean, I think eventually you can see that dynamic turnaround, but as I mentioned, job openings 10.5 million. That's one thing to say that there's still businesses looking for workers. You're looking at the wage gains and you have seen it modified, but at 4.6% or so, that is incredibly high relative to what is the median rate for wage gains year over year is about 2.5%. So it's almost twice that level. Again, meaning that businesses are still searching for workers. What I see as a positive is that if we see businesses start to say, well, let's just start to freeze hires, get rid of those, close out those job openings, but keep the workers we have, that could be, in a sense, a win-win for both businesses and workers. But again, it still remains to be seen what happens.
I don't know how granular you get in your analysis, but I do wonder, anecdotally, we've been talking about all these tech sector layoffs. Do you think those workers are going to be absorbed elsewhere? Is there enough slack in the labor market that there are other jobs for them?
Well, right now we have, I don't cover industries, and Meera might be able to comment on this. But what we see here is that, with an unemployment rate at what it stated, it went.
Now I'm forgetting something that I saw 2 seconds ago.
3.5%.
It's job day.
3.5%.
Yeah, exactly. 3.5%. That's incredibly low. There's so many people who are out of the workforce. There's still demand that it's very tight in terms of job openings, as I said. Still, business demand for workers is still very high. You can see it softening, but so I imagine that those people who have left the workforce, who either were laid off or for whatever reason, will be able to easily find something else.
Meera, you had mentioned this buying on the dip mentality that might reemerge here. And yesterday I was, and I think many of us may have been educated as to what the mullet trade is. That was the first time I'd ever heard of that. And so within this buy on the dip mentality that
I think Brent made that up, to be fair.
Brent made that up, okay.
I think that was his invention.
Well,
I'm not sure.
Brent Thill over at Jefferies invented the mullet trade on the spot and gave us some timing and said that we could just be kind of in this obscure and kind of downward declining phase over an extended period into 2024 even, with a back half of 2024 rally. And so especially within tech there, if we did see any buying on the dip activity here, even within this market, off of the volatile reports that could come out as the Fed is looking for a trend, how can somebody kind of position their time horizon over an extended period to really feel comfortable with buying on any dip that they may see over the course of 2023?
markets do not like uncertainty. And I think that right now, as that soft landing conversation reemerges, sometimes it dies down, it builds back up. We were just talking about that earlier. And that kind of uncertainty of a muddle along type of economy keeps investors a little bit on their toes, because if we see a recession imminent, if things are really starting to turn, then a lot more of that can be absorbed and priced into the market. If we're in a muddle along scenario for a longer period of time, then people are a little bit confused about where does the market bottom and what is that catalyst for the market to bottom and then start to rebound. I think right now we still need to continue to pay attention to what the Fed is going to do and when they will pause and at what level they will pause. I think that will be a catalyst for the markets, at least in terms of reducing that form of uncertainty when we get to that point, whenever that may be. But I'd say in terms of the investing strategy here, we can't get caught up in the uncertainty and get this investing paralysis waiting for a catalyst. We need to be sensible in our portfolios in terms of moving higher in quality in both stocks and bonds, taking advantage of areas where valuations have reset, and really focusing on the fundamentals as we start to get earnings, sussing through which companies can be successful in some of these more uncertain environments in which rates are higher and the barriers to entry in terms of being successful are higher.
I just wanted to mention one thing that I'm just seeing on Twitter from Justin Wolfers, the University of Michigan economics professor. He said he's calculated the unemployment rate to the extra decimal places, which he said brings him to 3.468%, which he says is a new 50-year low, the lowest since 1969.
And that's a good jumping off point for this one, Julie. I mean, Beth Ann, last word to you. Do you think we need to just stop being on recession watch?
No, I don't think we actually have in our base case a very shallow recession. We do think that, and again, it's not necessarily going to be in the near term. It looks like it's being pushed out a little bit. But I do see that some of the pain that that households are feeling, the squeeze in terms of the inflation on their pocketbook, means that they are starting to pull back on spending. Businesses who basically switched from just in time to just in case are now sitting with inventory that they need to unload. That means if they unload it, they're going to unload it at a cost, and that also means that they're going to have to let go of workers. We do expect to see the unemployment rate to climb higher, and certainly nowhere near what we saw during the pandemic, but we're looking at it getting close to, I guess we have it at 5.6 by year end or early next year. So we do expect to see a little bit of a pickup there. But that unemployment rate, I would expect that's also one of the reason why that unemployment rate is indeed so low is because there's not that many workers out there even looking for work.
Tremendous insight. JPMorgan Asset Management Global Market Strategist Meera Pandit and S&P Global Ratings Chief U.S. Economist Beth Ann Bovino. Good to see you. Thanks so much. Appreciate it.